Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and those 10-year note yields higher again for the second day in a row. A big bounce in 10 years from the 201 low we saw last Friday, north of 218 today. It's kind of been one of those recoup 2 days in this week where we've seen just basically an erasing of that entire pre-weekend flight to quality fear, you name it, whatever it was, it's gone. And now we're back to business as usual. So we're seeing Treasury yields rally. We're seeing stocks make new highs, gold going lower. Everything's kind of going back to that risk on trade that we've seen pretty much going back for several months. And if you look at one of the reasons today, we had a 10-year auction. Came through, it priced with a tail, about a 1 basis point tail, which basically means it was priced above. The yield was higher than expected. But I think that what that really suggests here is that there's probably a lot more upside to yield than we've seen. So 10-year note auction today kind of helped push yields a little bit higher, prices lower. The one surprise today was volatility. Yeah, we've seen a big reversal in the trend. Recall that trend we've seen, it's been coming on for months, pretty much since the beginning of the year, of lower trending yields. And then we see this big 2-day move. And what does it do to volatility? Well, absolutely nothing. We've actually seen volatility trade lower, back below 4% in those back month 10-year contracts, which is really kind of the Mendoza line, we'll call it, as far as where we like to see vol go above, at least when things are of concern or when we have key events on the map. And right now, while there aren't huge events on the map, we do have some inflation data coming out later this week. It's really all about the Fed. And if volatility is low and the market is bucking the trend, what it says to me is that the market's not fearful of the Fed coming in and with any big surprises. So, yeah, we might see an announcement on the balance sheet. We might see a little bit of tweaking here and there, but nothing big is coming from the Fed because recall one of the Fed's main initiatives since going to the zero interest rate plan has been to take volatility out of the market, which they've done very nicely. It's the intended consequence of low interest rates and a Fed-involved sort of capital markets. We've seen it not only here, but over in Europe. We've seen it in Asia. So that's kind of where we stand. If volatility can't go up when the market bucks the trend, when will it go up? And it really, I think right now we're going to be looking for the Fed to do nothing in September. Yields will kind of find a home between really right now getting north of 220 up to 2.25, I think is where we're headed for the short term. Then it all becomes about the data. But I think the Fed right now is not going to be a surprise. If it was, volatility would be telling us so. Likewise, the moves that we're seeing in the underlying 10-year aren't providing a bid to volatility. So bigger picture says all is well, remain calm, let the stocks do their thing, and then we'll have to wait and regroup, and we'll see what's going to happen geopolitically over in Asia, or we'll see what's happening economically or climate-wise here in the States, which could cause a little bit of a ruckus down the road. This is Todd Colvin coming to you from the floor of the CME Group.